Everyone. Today we have Mika Malone, the managing principal at Meketa Investment Group, to talk about the current market situation and how allocators can best invest in such an environment. Malone had identified opportunities in AI in 2019 and has ever since been investing with that idea. In this conversation, she opens up about red flags in managers, investing in AI and emerging markets, and dives deeper into the leaning sentiment towards mid market buyout strategies. Welcome, Mika. So, Mika, you had already identified AI to be a game changer in 2019. How did you plan and invest ahead of time?
So I'd say, we invested internally in building our own models and tools to take advantage of some of the technological advances in AI. And then as we looked outward to kind of client portfolios and thinking about the AI revolution, if you will, the early opportunities, I think, were on the private side, as you would expect. And so our teams in private equity and other private asset classes are always looking at, what GPs do we love? Have a proven track record, have done great things for clients over time? And then also, who has access to the information on what is happening in AI? What should we be committing to for the future? Because as you know, you're locking up capital in a venture fund for 10 years plus. So we want to make sure that we're partnering with the right organization. So, I would say early on, we leveraged relationships that we had for many years with excellent GPs. And then we also spent time searching for exposure and access to GPs that maybe we didn't know as well, but that had a specialized, set of experience or background working. Some of the GPs in that space came from huge corporations where they were running internal models. And so, as the marketplace shifted, I think that provided opportunities as well.
Amazing. And could you dive a little bit? That's really interesting, actually, that you spoke about, identifying and seeing GPs through a new lens. Could you dive a little deeper into that? Like, how has that changed? And like, what are some red and green flags that you look for now?
Yeah. So, to me, wanting to find partners for our clients that have experience doing the work that they're investing in, is just one additional layer that gives you confidence that they can, figure out among all of the AI products out there, right, that they may have an information advantage in terms of what products will come to market, what will be successful. And so, to me and to us, the green flags are people who have been in their space for a period of time, right? So a lot of exposure to various tools, to models, to seeing what's out there, and reinforcing that kind of operational diligence that we do and the investment diligence to make sure that these are people that really do have that advantage. And then, to me, red flags are always going to be groups that are kind of pressuring investment just because the market's moving quickly and they try to capitalize on everybody's doing this, you need to get in now or you might not get in. I think that we have to really be careful, even with new great technology, that we don't rush to make an investment on behalf of our clients that we haven't done our full diligence on. So although AI is very exciting and we can use it both to analyze things and to invest in, it doesn't change the fact that we're committing to a blind pool of capital for a decade, and we need to make sure that we have a lot of confidence in the GPs that we're investing alongside.
That absolutely makes sense. And within the private equity portfolio, why do you think mid-market buyouts are performing better than secondaries? Or like, why is the sentiment changing in the market?
Yeah, so I may have less knowledge on, specific performance differentials in this space, but one thing that I find really interesting, and I think this might get to a couple of questions you have later as well around liquidity, but to me, what you're seeing in kind of the mid-market space are continuation vehicles being offered to investors, which to me, I think does two things from a performance standpoint. It allows a GP and the LPs invested in the fund to stay invested in some high conviction names that just for various reasons in the marketplace, aren't in a position to kind of move to that next round or to be sold yet. So you have the opportunity to stay invested in a great opportunity But you also, for LPs who are invested who may be overweight the asset class today, which a lot of folks found themselves in, they have the ability to get liquidity, right? So continuation vehicle says, hey, do you want to stay in or do you want to receive liquidity out of the portfolio? To me, that's really important in an environment like we're in today, where some groups are still building portfolios and want to maintain more exposure, particularly to the highest conviction names in a GP book, but where other investors maybe double their target weight to private equity and they really need liquidity. And so for them, even if it's a minor haircut over current market value, they want that liquidity to be able to bring their whole portfolio back into kind of its risk parameters. So to me, that's important in the mid-market space. And then the secondary space is offering a really similar structure, right? If you're a seller into the secondary market, valuations are relatively attractive to be able to take capital back, maybe not at what you had hoped you would get to over the next 3 to 5 years, but at a really reasonable valuation for today. So then you can sell those assets, again, trying to move your portfolio back towards its target weight. And if you're a buyer of secondaries, you have so much more visibility into what you're buying than if you're just investing in a blind pool. And so to me, that's another area where kind of the supply and demand of the private equity marketplace is coming together to help people, get liquidity if they need it, but also get, investments in more mature portfolios if those investors need it.
Absolutely. And are there any sectors or sub-strategies which you think would make investors an alpha within the mid-market buyout?
Yeah, it's so really hard for me to say what I think, will be the best subsectors going forward. Certainly technology, I think, is going to continue to be a place with a lot of investment. So I think there'll be big winners there. But with any sector like that, I think you'll also find folks who get left behind and where performance is not as attractive. So I think, the other areas in my mind that are shifting in kind of the private equity space are things around, healthcare, things around, how is the biotech market shifting and changing over time as well. So there's so much going on geopolitically around us in the US, in Europe, in Asia, where different governments are spending capital and where, shifting demographics are driving needs, I think will really determine what the great investments are over the next 10 years. And so to me, it just gets back to wanting to have a really quality, diversified portfolio, right? I wouldn't want to put all my eggs in any one basket today.
Absolutely makes sense. And as numerous allocators face liquidity issues, why do you think investing in venture capital and mid-market buyout at this moment might be beneficial? I know you've spoken about it a bit, but I'd love for you to expand.
Yeah, so I think even if you're overweight a particular asset class like private equity, or your venture portfolio might be particularly overweight, you, as a long-term limited partner in these vehicles, you want to maintain vintage year exposure, right? So you don't want to miss out on 2024, 2025, 2026 exposure, because we don't know which of those years will be the very best year for venture out of the next 5 or out of the next 10. However, if you're at double your target weight, we also know that you can't let the tail wag the dog, right? So just because there are great opportunities, you have to face the music a little bit in your portfolio. And so to me, you can't ignore the fact that maybe the pacing models you used yesterday or the thesis you used yesterday in terms of how many dollars you are committing to those strategies might not be the best strategy going forward. And so I think that in some cases, allocators are having to cut back on what those commitments are. To me, and I have my own perspective on this, and others may disagree, but I think one of the big challenges over the last 5 years is that the markets were hot and GPs were coming back to market on a faster cycle than they had historically. So a lot of plans' whole long-term focus is to keep recommitting to good GPs that they've worked with over the years. And that used to be every 3 or 4 years, those GPs would come back to market and you'd make the same commitment, cycle over cycle. But now they came back to market after 18 months or 22 months or 26 months. Well, now all of a sudden you kept doing the same thing, but with the results of growing your portfolio faster than you had expected. And then you had 2022 and public equity markets drew down. So now all of a sudden the denominator shifted and your private equity got to be a much larger weight. Now, in the last year and a half, the public markets have come back dramatically. However, you still committed a lot of capital to the privates, and you're not seeing distributions pick up in a huge way. I think with Fed rates where they are and other kind of factors in the marketplace, there just haven't been the exits. And so I just think people have to be realistic about how they view liquidity. You know, we all want the good returns of private equity, but we can't ignore the portfolio allocation that our boards of trustees and our consultants and our staff spend a lot of time modeling, right? So I think you just have to be realistic about the risk in your portfolio. And that might mean that you do have to cut back a little bit in your pacing for the next several years.
Absolutely. And more, like adding on to that, how should allocators invest and to what extent should they take a risk when threats around liquidity arise?
Yeah, so I think we're all in the business. If you're going to invest a portfolio of capital over 20 years, we're in the business of taking risks. So we have to accept that. So I wouldn't let the current market scare an allocator away from being willing to take that risk and keep investing in those ideas. I just think that the prudent approach going forward is to make sure that you're cognizant of what that looks like in your broader portfolio and to be really, I'd run a lot of scenarios and hey, maybe this is a place I haven't seen these tools necessarily yet, but my guess is that AI can help us model out a little bit more about what distributions have actually looked like relative to predictions. And let's think about what the private equity marketplace has shaped up to look like today, how that's different than 10 years ago and 20 years ago, and how do we invest for the next 10 years and 20 years to have a better outcome in terms of exposures going forward.
What do you think are the best practices when it comes to investing in mid-market buyout and venture capital portfolios?
Yeah, I think best practice in the private equity space, and particularly as you look at a lot of venture funds that are, you know, in some cases, they're certainly investing in newer technologies and newer underlying companies. And in some cases, also a lot of newer GPs come to market in that space. So you're looking at sometimes new GPs investing in new technologies. And so to me, you just can't skimp on due diligence. And that's not just, you know, investment diligence, but it's operational diligence, right? Make those background check calls, call folks that these people have worked with at other organizations, make sure that you are really comfortable that these are the people you want to partner with in the decades to come, because it will be decades. And I think we all want to avoid being on the front page of your publication or any other publication with a blow up that comes from a lack of attention to detail. So to me, you know, really focusing on who are the people that you're working with is a critical piece, because good decision making and good investments are important, but working with trustworthy individuals is also really important.
Absolutely. And moving on to private credit, like we spoke earlier as well, a lot of managers are offering credit, but whether it will stand the test of the time is like a very big question. What are your thoughts on that? And what kind of managers do you think actually do stand the test of time?
Yeah. So in terms of private credit broadly, you know, one of the things that we discussed a little bit earlier and that I think is important is, you know, we're all kind of recalibrating the way that we view the risk and return opportunity set in portfolios. And so today, if I can earn 5% on effectively cash, everything else has to be viewed relative to that, because I can get a lot closer to 7% with very low risk assets than I could 3 years ago. That said, if you do think of things on a relative basis, generally speaking, I think that means in places like private credit, there are also opportunities that are offering significant returns, right? Double-digit returns with, when considering a whole portfolio, are still lower risk than some of your private equity or other asset categories as well. So what I think is really important is to remember that private credit is also a hugely diverse asset class in and of itself, right? You've got direct lending, specialty finance, special situations.
Yeah.
So we like to think of making sure that within that bucket, whether it's 5% of your portfolio or 10% of your portfolio, that you make sure that that's diversified, right? It's not just a let's go find one middle market direct lending strategy and that'll be good and we have our exposure now. So I think that, the relationships that we want to build over time are with a diverse group of underlying managers. And then let's view those risks as we sit today, right? So within each of those sectors, kind of thinking about what we could be doing with this capital in other places, how many dollars do we want to put to work here? And what do we expect from these assets going forward? I think one of the reasons that investors have really liked private debt, in addition to historically not being able to get much from their public fixed income portfolios, but as we sit today, I think it's also a more attractive time horizon. So when we just talked about private equity and I said, you're committing to those funds for 10, 15 years, the cycle just never seems to end. But in private credit, you tend to have a time horizon that's much more palatable. And so I think, okay, if you can earn that 10 or 12% and it's over the next 3 to 5 years and you can kind of see the end of that tunnel for a group of trustees or a staff or us, I think there still is some attractive attributes to wanting to commit to private credit. So we do put a lot of resources into evaluating the private credit markets. And I think that what we want to do is just make sure we're not getting sucked into just one component of what that marketplace looks like. If I could answer for you what manager will stand the test of time, I hopefully would be running a large hedge fund or fund of funds somewhere. So I don't know who will do the best, but I think that, again, getting back to my earlier comments, that these are partnerships with people. And so, we want to be really cognizant of the investment opportunity set and also just those individuals that we're excited to partner with going forward. So I think we'll continue to focus there.
Amazing. So like you mentioned that, there are like a lot of strategies within private debt itself. Are there any particular strategies during during current circumstances that you think are performing well or would act as a good hedge?
No. I'm certainly not the best person to answer that question, but what I would say today is that in thinking about the role that private credit is playing, as you're seeing banks after Silicon Valley Bank and a lot of what we saw in kind of the smaller banks over the last several years, I think there's a lot of reticence on the bank side to provide loans to the companies who need it. And so I think private credit is playing a really important role in the marketplace. And so to me, I'd be thinking, with the GPs that we invest alongside, how are they viewing that market? Like what need are they filling? Where are they stepping up where others have stepped back? And I think that'll be a really critical decision point in terms of, making your money and making a good return with a reasonable amount of risk going forward.
Absolutely. And within impact investing, what kind of trends are you seeing at the moment?
Yeah, so impact has been such an interesting place that I think it's wrapped into some of the kind of political debates that we're seeing around the country. The way that I like to think of it is impact investing is probably the most ripe area of a portfolio to align your investments with whether it's your values or the mission of your organization. And so we tend to see a lot of impact investing in endowments and foundations where they can take capital and invest in their communities or invest in global opportunity sets that align with their vision and their mission. The things that I've seen shift over time, and particularly in this environment, is there's just a lot more desire to be able to measure outcomes, right? So it used to be that, people viewed impact maybe as a feel-good place to invest and that the return was secondary. I think that today people view it as if we can do this, but we should expect to receive good market rate returns. And given the pressures of things like ESG and DEI in the market, everyone feels kind of a renewed need to be able to prove that these investments are adding value. And so to me, what I see are a lot more allocators wanting to make sure that their portfolios are up to snuff and look like the high quality investments that they believe that they are, and that the managers investing that capital can show that there's kind of a long-term thesis for being able to see strong returns on investment. And I think it's out there. I just think that every organization is going to view that a little bit differently in terms of where the scales get tipped.
Absolutely. So when they view this differently, are there any particular sectors or strategies they're adopting to make sure that everything is favorable?
So I think it differs quite a bit by client. I would say the places where I hear a lot of interest are in things like the energy transition, right? Wanting to make
Mm.
sure that there's exposure to, where that aligns with an organization's vision or mission, making sure that there's exposure there. I also think that, you see the private space has always been really, really the primary opportunity set for kind of impact investing, right? You see private equity being there, private credit even in some cases being there. What I'm seeing more today are public strategies that are helping investors kind of focus on those areas. And so I think that to me, that's been a trend in impact and Meketa as an organization has done some work to identify high quality impact focused managers out there so that investors have more tools in their toolkit.
Amazing. Which sectors and strategies you think will perform well within the ESG space and which won't?
Yeah, this is one of those questions where I'm going to claim ignorance because I wish that I could tell you what sectors will perform well in the ESG space. What I will say is that setting aside the politics of the conversation, good governance I think is an attribute that every investment manager in public and private markets would agree is a core component of finding good investment ideas. And so in this environment where maybe certain parts of the E or the S are flagging people's kind of political backdrops and creating tension, to me, good governance shouldn't have that type of a backdrop. It's really organizations that you would want to do business with. And an interesting point that I'll make, because I know you want to talk about India a little bit later, but to me, that governance and how companies are doing business within their various, whether it's their sector here in the US or whether it's in India or China or Japan, the governance and the investment structure that's in place for a lot of these groups is what causes your average investor to feel more or less comfortable committing to equity capital in that space. And so I think that that's really important. And I would be surprised if we don't continue to see an emphasis on how governance in these different regions really contributes to outside capital flowing in their direction. I think that's really been one of the areas that India is focused on.
Absolutely. And what kind of, like, again, coming back to the same question we discussed before, what are the few red and green flags you look for when you look at like managers who talk about impact investing or ESG?
Yeah, I think that for me, a red flag would be investors who are trying to raise capital, solely because of a political or social backdrop, right? I want to see, to me, a green flag is somebody who has found a niche or an area of the marketplace where they can put capital to work and expect strong returns. And probably many of them do that through their own lens. We all have our own biases and lenses, and that's just the nature of investing. Whether you're investing in, tech stocks or you're investing in an ESG focused strategy, this is just the kind of the apex of active management in my mind, right? And so these strategies are really focused on particular sectors of the market and areas, and I think they need to be able to show how their lens and their tools allow them to be good investors and make good returns for folks over the long run. And so to me, that's how I would want our research teams to be focusing their efforts is, what tools are at their disposal, what's the opportunity set, how can we see that these firms are going to add value going forward. And, red flags would be folks that are just trying to kind of play to a political initiative on one side or the other and try to gain capital or take it away from others just with that reason. I think I want to see investors who are trying to earn returns for the underlying.
Absolutely. Within the emerging market sector, why do you think investments in India are rising?
Yeah. So India's been really interesting. So we now have, population in India greater than China. So, largest democracy in the world. And as those demographics shift, so too has the stock market in
Yeah.
India. And I think to that governance point earlier, the marketplace is and it's been an evolution. It's not a revolution, as we like to say. It's taken time,
Yeah.
but the markets there have opened up to a degree that I think outside capital has felt increasingly comfortable investing in Indian companies. And so to me, what makes India attractive relative to China is that opening up, right? It's, you're seeing, you can sort of look through and see the governance, way less state-owned enterprises now in India than in somewhere like China.
Yeah.
So on a relative basis, as you look at these two powerhouses in the emerging markets and really the global markets today, India, I think, has taken a lot of strides to open up their economy to show investors what can be attractive about investing in that improved demographic base. China's demographics are getting older. There's more state-owned enterprises, a lot more government control. So what you see now is that while China is still the largest component of emerging markets, India is right behind it. You're looking at only maybe a 6 or 7% differential between the two. It used to be dramatic. I mean, I think just 4 or 5 years ago, China was like 46% and India was, 5 or 6%. And now you're looking at India at 16 or 17% and China at 24 or 25. So really meaningful shifts and that would just be an investor passively investing in an emerging markets index. Obviously, I think investors are also interested in taking advantage of active management in that space. And I hear, when I look at how managers have performed over the last couple of years, you've seen a lot of managers be able to make good investments in India and see those good returns. And so to me, I can't predict specifically what sectors I think will do well in India, but what I do think is you're going to continue to see India grow as a kind of component of the markets. Its market capitalization has grown, its GDP growth improves. It's really on the world stage looking more attractive. And I think that'll provide a nice opportunity for investors who have felt maybe somewhat limited by how significant China is as a component of the emerging markets.
Continuing on that topic, are there any particular strategies that you think especially allocators and GPs in the US are particularly excited about in India?
Yeah, so what I have not yet heard of folks breaking out India exposure the way that I've seen them do so with China, where you have some investors kind of investing in just China and then kind of ex-China as two separate strategies. But it wouldn't surprise me if in the next 5 years you start to see folks say, hey, India is becoming a big enough component of the markets that maybe we want to have dedicated managers, active managers who focus there. So to me, that's a question mark and one that we'll watch. In the private equity space, I think it's still younger. I don't know that I have enough insight yet to say, where are folks really seeing that drive, but I do know that, as the demographics in India are so supportive of a young working population, particularly in kind of STEM and engineering, it wouldn't surprise me at all to see that there is a lot of opportunities in those spaces, right? In technology and engineering. This is where a lot of the workforce, even in the US today, is driven by people coming over from India with really strong academic backgrounds. So I think that'll be a really interesting place to watch.
Absolutely. And how and why do you think are Fed rates impacting fixed income and real assets sleeve?
Yeah, so Fed rates, the big question mark for all of us is, are we going to see rates now? We talked about lower for longer for ages. I mean, I've been around long enough to have seen multiple white papers come out about how low rates were. And then almost overnight, we were in a new environment of rising rates. And now we sit today talking about how long are rates going to stay high?
Yeah.
I don't think there's consensus views right now. But what I will say is current rates are certainly supportive of shorter duration fixed income assets, right? You know that you're earning a yield on fixed income today that is significantly better than what you earned on a treasury 3 or 4 or 5 years ago. So rates are higher today on the short end of the curve. We're still in that inverted yield curve. So the question becomes, okay, at what point do we start to see that yield curve normalize and you actually get paid for moving out on the duration spectrum? So I think that's a question mark. What I do know is, when we're modeling asset allocation, fixed income today looks significantly more attractive than it did when rates were at 2%. So rates at 4 or 5% are much higher, even if we believe that rates will come down. And I think we do believe that they're going to come down. I don't know that I think they're going back to zero anytime in the near future. And I think there's some pretty good arguments out there to say rates will stay higher. Like we were at an abnormally low rate for quite a long time, and that's the abnormal piece. And that really, we probably will come down from 5% to 3%, but I don't know if we go back to, to sub that. So we might be in an environment for the rest of my career where you earn something on your short duration assets. And I think that is transformative for how investors think about asset allocation. In terms of real assets, that also flows into places like real estate, for example. And I think, that marketplace, which has been really challenged, particularly in the US office sector, and has kind of structural headwinds in that way. To me, if rates do come down a bit over the next year, that will certainly help that sector and be a tailwind. I can't estimate specifics of what it will do, but I would expect that if rates come down, you're going to see fixed income perform well, and you're likely to see a tailwind for things like real estate. So I think that would be attractive.
Do you mention any specific sectors in both the asset classes that you think, would perhaps face the most impact, are facing the most impact right now?
Well, I think, getting back to that risk question, I like to focus on the things that I have the most insight into, or that we can have the most insight into. And so in fixed income, knowing where yields are today, to me, means there's a lot of opportunity in actively managed fixed income portfolios, right? You know what treasuries are offering you, but I think there's some room as you take on more credit risk in various sectors to add yield and for active managers to do well. So I think we're seeing interest in things like 4+ fixed income, which didn't have a lot of interest for a number of years because the overall returns were so low that people didn't care as much about the alpha. I think today people say, oh, if fixed income can get me 4, 5, 6% plus a manager can add, 40, 50, 60 basis points, that starts to look very attractive. So, I'm seeing a lot of interest in actively managed core bond strategies, core plus bond strategies. There continues to be interest in things like high yield and bank loans in the public space. But again, you're always weighing those opportunities with your private credit sleeve. So I think that'll continue to be a debate over time. Where's the risk, but then where's the liquidity? So I think you'll see investors grapple with, which place they really should be focusing their capital. And maybe it's both, but I think everybody's going to have that conversation. In real assets, so in things like real estate, we have still seen less interest in things like core real estate today, just given the cap rate environment we're in, given where lease rates are at in office and how significant that is as exposure in some of the core funds. And that said, I think that there are some newer, core real estate funds out there that are starting with fresh capital. That looks a little bit more attractive today. And there's things like data centers, as we talk about AI and we talk about distribution still with groups like Amazon. I don't think that the need for large pieces of real estate to support that type of work is going to go away anytime soon. So I think that there could be some real opportunity in that space as well.
Amazing. And before we wrap up, I'd love to ask you about a few trends that you foresee for the next 5 years.
Yeah. So I think AI is definitely has to be at the top of my list, probably at the top of lots of people's lists. I think how it will impact, private markets, public markets, asset allocation modeling. To me, there's just so many ways that it is intersecting with the institutional marketplace. It's important for all of us to stay educated on that topic. When I think about other trends, to me, looking at governance globally, we talked a little bit about India, but Japan's another economy that we haven't seen do a whole lot in a long time. To me, watching places like India, like Japan, continuing to watch China, I think some of these conversations are going to be global in nature, but pretty focused regionally on what do those opportunity sets look like. So I wouldn't be surprised to see more investors either using active management to take advantage of those, using private markets to invest in specific opportunities in those regions, or potentially breaking out their index exposure to specifically focus on those regions. So I think that'll be a potential trend going forward as well. And then, I also think that we're going to continue to have a backdrop of really challenged politics across, I work with clients across the country in red states and blue states. And, I have peers who work with clients across the globe in similarly fraught environments. And to me, I think it will be incumbent on all of us to make sure that we're all continuing to educate ourselves about the investment marketplace and coming in with really, an academic approach to understanding what the risks are and what the opportunities are so that we can focus everyone's energy on the things that really matter, which is, paying benefits to retirees or investing that endowment capital and building new buildings and not getting caught up in what could be, I think, a really fraught kind of political environment.
Amazing. That sounds great. Thank you so much for being here today. It was really, really nice chatting with you.
Yeah, really nice to chat with you too, Aurora. Thank you so much for the opportunity.
Oh, thanks for being here.